Hi everyone. So welcome to the live stream today. Very much excited for having you on the part 2 in our discussion for the ICA May 2021 examination, focusing on the IFRS masterclass with standards in relation to IAS 36, impairment of assets, and IAS 38, intangible assets. Now, in case you missed the part 1, that is yesterday's discussion, the link is in the description of this video. You can watch that so that you build up the understanding to help you in order for you to ultimately understand the topics and also be able to pass the examination. I see some of you guys joining the stream. Welcome to the stream. Smash the like button when you join the stream. That way we get more engagement on the video, and YouTube will be able to push the video so we can reach as many students as possible. So together we can assist a lot of students across the country, across the continent, and across the globe at large, so we can together become more successful. I see some comments coming in from Leonard Montadi. Said, good evening, sir. Leonard from Zambia. Good evening, Leonard. You are welcome to the live stream. Jeremy Rouge, good evening. Hi, Jeremy. Good evening. I hope you're doing well. Roland Cujo. Hi, Nhyira. Good work. Thank you very much, Roland. I hope that you're doing well and you've enjoyed your week so far and how it is going. Right, so thank you very much for joining the stream. Smash the like button when you join. We want to go straight up into our discussion on IAS 38, intangible assets, and IAS 36, impairment of assets, and see how we can build up in there. So let me share my screen with you real quick as we get into that. You ready? Let's go. Let's see what we got. Boom. I think we're here now. Let's see. So we started yesterday's discussions with looking at the issue in relation to IAS 36 and IAS 38, impairment of assets and intangible assets. But most importantly, I told you something that we're going to start with IAS 38, intangible assets, and as we continue with it, IAS 36, impairment of assets, is going to bring itself naturally. We're not going to force it. It's going to be coming naturally in that case. So we started the discussion with intangible assets and made mention of the fact that intangible assets are simply non-monetary assets without physical substance. And we gave a couple of examples as goodwill, software, patent, customer list, franchise, brand, research and development. But we made mention of the fact that IAS 38 paid significant attention to how research expenses should be treated, how development costs should be treated, and also how goodwill must be treated. So we looked at a couple of issues, and focusing on the recognition criteria, we mentioned that it should be an identifiable asset, separately identifiable asset, which means that it can be acquired, it can be rented, and it can be sold on its own separately. However, it should be probable that a future economic benefit attributable to the asset will actually flow to the entity. And then the third thing is that the cost of the assets can be measured reliably. And that was what we mentioned when it comes to the recognition criteria. And then we spent some time to look at the treatment of research and development. In a nutshell, what we mentioned was that when it comes to research expenses, all research expenses must be written off in the income statement as incurred. So as and when we incurred any research expenses, we write it off. However, the standard states that any capital expenditure that is incurred on research equipment should be capitalized and amortized or depreciated over the economic useful life of the asset. So that was what we mentioned categorically when it comes to the issue in relation to research and development. Then we raised that up to development issues. So the first one was research. Then we came to development. We said that development has to do with the application of what? Research finding. And we made mention of the fact that the standard states that all research expenses shall be capitalized if the criteria is met. And we made mention of the sector criteria, that it should be separately identified projects. The cost should be reliably estimated. It should have a ready market or commercial value. It should be technically feasible. And overall, it should be profitable for the organization. So on the overall, it should be profitable of the organization. Not only that, there should also be resources available to complete. There should also be resources available to complete. Then we spoke about goodwill, centered around the fact that internally generated goodwill cannot be capitalized, but the goodwill that has to be included will be goodwill that arises from purchases of the asset, purchases of another business, purchases of another business. Then we spoke about the initial recognition. We said we debit intangible assets, credit, cash, bank, or payables, depending on what we are having under the scenario in question. Right. So this was what we discussed yesterday, and we want to build it up to the subsequent measurements. Now, after the initial recognition of assets, the next thing that comes to mind is subsequent measurement. So now, on the initial recognition, we've debited intangible assets, we've credited cash, bank, or payables, depending on the scenario and whatever is going on in the question. But the question we need to ask ourselves is, how do we now measure it subsequently? How do we do the measurement? And so that is what we want to look at real quick and see how we carry out the subsequent measurement. Desmond said, good, sir. Hope you are doing good. Yes, I am well, Desmond. Unfortunately, I couldn't join you yesterday. Okay. So you can watch the video in the playlist, the accounting standard playlist, and watch the video. You can also check the description of this video. I've included it also there so that you'll be able to watch it. Now, on subsequent measurement, IAS 38 states that there are two models that can be used to account for intangible assets. So there are two modules or approaches that can be used for accounting for intangible assets. So what are these two modules? One, the cost module, and two, the revaluation module. The cost module and the revaluation module. Now, if you're a good student of IAS 16, you shouldn't have problem with these things because they're going to be the same in that case. But a cost module is simply where the intangible asset is carried at its what? Historical cost. All right? The intangible asset is carried at its historical cost, meaning that the cost that it was initially recognized. For that reason, we said that under the cost module, the carrying value of the asset is going to be equal to the cost of the asset minus any subsequent accumulated amortization or impairment loss. Or impairment loss. Right? So stay with me carefully on this one. So using the cost module, it is where we are carrying the asset at its historical cost. That is the amount at which it was initially recognized. For that reason, we said that the carrying value or the carrying amount of the assets will now be equal to the cost minus any subsequent accumulated amortization or impairment loss. That is the cost module, very simple, straight to the point. But the standard also states that the entity can also adopt or use the revaluation module. Now, like the name suggests, and you know already from IAS 16, it is the same school of thought that we're going to be applying in here. So it means that here, the intangible assets will be carried at what? The fair value. Now, if you remember from our IFRS masterclass, the beginning, we define fair value as the amount at which an asset can be exchanged or a liability settled between market participants in an arm's length transaction. So fair value is the value at which an asset can be exchanged or a liability settled between market participants in an arm's length transaction. That is what we mean by fair value. Fair value. So under the revaluation module, we are carrying the assets at its fair value. For that reason, we made mention of the fact that the carrying value of the asset will be equal to the fair value minus any subsequent accumulated amortization or impairment loss. Or impairment loss. or impairment loss. So these are the two things that we need to understand when it comes to the issue in relation to the cost module and the revaluation module. But a big question we ask ourselves always is, when can an entity use the cost module and when can the entity use the revaluation module? There are a couple of issues. I think I've discussed this with you already under IAS 16, but the same concept actually comes here in that case. So conditions for the usage of the module. Now, this applies to IAS 16 as it applies here. Number one, if the fair value of the assets can readily be determined. In other words, there is an active market for the assets, then we can use what? The fair value module. So do we have an active market for the assets? Then we use the fair value module. If there is no active market available for the assets, then we have to go with the cost module in that case. Because the fair value module means we are going to be carrying the asset at its current price. How do we determine the current price of the asset? We can only determine the current price of the asset if we have an already existing market where there are buyers and sellers of that particular class of assets that we are dealing with. Number two, if the asset is of a specialized nature, meaning that it will require an amount of modification before it can be used by another organization or a third party, then it will be favorable to use the cost module. Okay, because if it is a specialized asset, it's a customized asset, then chances are it was done in our name, it was done based on our specification. So it will require some modification before it can be used by another entity or another company. For that reason, such assets, it will be appropriate for us to carry it using the cost module and carry it at its historical cost, amortizing it or still carrying it at the initially recognized amount. So if there is an active market, we use the fair value module. If there is no active market, use the cost module. If the asset is of a specialized nature or a customized asset, we use the cost module and carry the asset at its historical cost, less any amortization or impairment if we so see it like that. But if it is not a customized asset and there is a ready market available, then definitely we can use the revaluation module. Now, there is something you've got to understand, that where an entity is using the revaluation module, the following must be taken into consideration. Okay, so where an entity is using the revaluation module, the following must be taken into consideration. And you want to make sure that you understand the concept if you want to establish here well, because it's going to position you in order for you to really understand what is going on, to really understand what is going on. Now, all non-current assets of a particular class must be valued together to avoid selective revaluation. So that is very important. So we pull the assets in a group, in a category, in class. So the assets of a specific class must be what? Valued together to avoid selective revaluation. So you don't say, oh, okay, all our intangible assets, we have revalued patents, or we have revalued a franchise that we bought, or we've revalued this, and the rest of the intangible assets will not be revalued. No. If we pull the assets in a certain class, then as far as we're using the revaluation module, the assets of the same class should be revalued together so that we avoid any selective revaluation. So that is something critical you need to understand in there. Then remember what I mentioned a moment ago about the issue in relation to some of the things that we need to talk about. So aside we revaluing the group or the collection of the assets, a couple of issues that we need to also understand is that the fair value of the assets must be measured reliably. Must be measured reliably. must be measured reliably with reference to an active market. With reference to an active market. Now, this is very critical in here. So you're not going to just get up and say we've revalued an asset. No, we have to have an active market. There has to be an active market where we can really determine the price of the assets in question. 2, not only that, where the fair value cannot be determined, the asset must be carried at cost less any subsequent amortization and impairment. And I've mentioned this already. So where the fair value cannot be determined, maybe the market has collapsed, cannot be determined, the assets must be carried at cost less subsequent amortization, subsequent accumulated amortization, and impairment loss. And impairment loss. I hope you're following the picture well. So first, the fair value must be determined reliably with reference to an active market. 2, where we cannot determine the fair value of the asset, what do? We carry it at cost less any subsequent accumulated amortization and impairment. 3 is that revaluation should be done. Revaluation should be done on a regular basis to ensure that carrying amounts are not materially different from fair value of assets. Okay? So revaluation should be done on a regular basis to ensure that carrying amounts are not materially different from the fair value of assets, are not materially different from the fair value of the asset. So these are 3 key things that you have to observe or have in your mind as you are looking at the issue in relation to that, as you are looking at the issue in that case. Any questions, please? Comment in the chat box, any questions you have. I see some of you guys joining. You are welcome to the stream. This is the part 2 of our discussion on IAS 38 and IAS 36, intangible assets and impairment of assets. This is relevant for those writing financial reporting, F7, ACCA F7, or SBR, strategic business reporting in ACCA, or financial reporting in ICA, and corporate reporting also in ICA. This is valuable, really, really fundamental in there. Smash the like button when you join and you are getting some value in the video. It helps the channel a lot, makes the channel more engaging, and YouTube will be able to push the video so we can reach as many students as possible. So when you join the stream, smash the like button, let it turn blue, and also share the channel. Let's reach as many students as possible. So together, we can assist a lot of students across the country, across the continent, and across the globe at large. So that is it about the revaluation module. But you realize that when we were talking about the modules, 2 things pop up, or 2 things came up, or 2 issues came up that we need to really expand on and try to get our understanding and our head around that well. You see that amortization is coming into the picture as well as impairment. Now, if you remember in the beginning, I told you that impairment is going to bring itself naturally. You see what I was talking to you about? impairment has brought itself naturally. So we're going to transition in a moment from IAS 38 to IAS 36 so that we can build our knowledge and build our understanding in that case. So let's look at amortization of assets. Amortization. Amortization. Now, unlike tangible non-current assets, we depreciate them. But intangible non-current assets are usually amortized. But you got to understand that amortization depends on whether the asset has a definite economic useful life or an indefinite economic useful life. Be careful here. So amortization depends on two things. Whether the asset has a definite economic useful life or an indefinite economic useful life. And I want you to stay with me carefully here, because you don't just going to get up and say we are amortizing the asset. No, before you're going to amortize the asset, you're going to ask yourself, what is going on here? Is this asset having a definite economic useful life or an indefinite economic useful life? Now, the standard states that assets that have economic useful life will be amortized. That means that the cost of the asset will be amortized over its economic useful life, so that the amortization will be equal to the cost of the assets divided by any economic useful life. The cost of the assets divided by any economic useful life. But the standard states that where the asset has an indefinite useful life, then certainly we cannot amortize, okay? So we cannot amortize, no amortization is charged. Instead, we test for impairment. Instead, the entity tests for impairment periodically. Are we following so far? Are we seeing what's going on here? So does it have a definite economic useful life? Amortize the cost of the asset over its economic useful life, meaning that you're going to be using the straight line basis, okay? What you know from IAS 16, straight line basis. You're just going to be amortizing it. But if the asset has an indefinite economic useful life, we don't amortize. Instead, we test for impairment. Any questions, please? Any questions? I see some of you guys joining. Smash the like button when you join the video. Gives us a lot of engagement on the video. Comment in the chat box the topics you would want me to cover on the channel as well. Desmond said, I seem not to follow today's lesson. I guess it's because I missed yesterday's lesson. Oh, yeah, partly it could be true because you could CIMA through, but it's also something that you can understand. So maybe, like I said, you could watch the part one, the yesterday's lecture, then you come back to come and watch this, so you'll be able to follow through very well. Penny Pri, good evening, sir. Forgive me if I don't mention your name right, okay? Good evening, sir. Good seeing you once again. God bless you real good. Amen, and God bless you too. Now, for those of you who are looking for and really getting access to our full content and be able to study directly under my mentorship for your examination, you can enroll in our full course on our study portal at NhyiraPremium.com, and it is 390 Ghana cedis per paper or $68 US. 390 Ghana cedis per paper or $68 US. This gives you access to all the lecture videos, all the standards, our ebooks, our question kits, and you'll be also joining our weekly live Zoom sessions and study directly under my mentorship as I assist you in order for you to prepare well for your examination and, most importantly, pass the exam. So you can see the link in the description of this video and also pin in the live chat message there. You can click on it and then head on to our website, NhyiraPremium.com, and enroll in a course. You can make payments using any mobile money account or Visa or MasterCard directly online and start studying and join our community. And let me assist you in order for you to prepare well for your examination. Right, so that is it about the concept of amortization. But what are some of the examples of assets that we can say that we need to amortize them, and the asset that we can say we need to test for impairment? Now, the concept of this actually spans across a number of issues. Like for instance, if we buy a franchise, usually a franchise will have a definite economic useful life. So for those ones, we're going to be amortizing them. But if we acquire a business and we realize goodwill, we don't amortize goodwill. What we do is to test for what? Impairment periodically to see if goodwill has suffered an impairment. If it hasn't suffered any impairment, then the goodwill will still be carried at the amount that was initially recognized. At the amount that was initially recognized. So the concept of a franchise is this. So let's say, for instance, I want to open a restaurant. And I want the restaurant to be a great restaurant. And so I wanted to put a name on it. And I wanted to put Kempiski's name on my restaurant. And so I go to them, I say, hey, I meet the management and the board, and I'm like, hey, I want to open a restaurant probably somewhere around It's Legon or somewhere around La Paz or wherever it is. But I want you guys to, I want your brand name, I want your name, everything about you guys. I want it just to be a top notch as your resident things are. And they said, all right, Nhyira, we got it. We're going to give it to you. And they said, right, we're going to let you use our name for 10 years. But in return, you're going to pay us whatever, let's say $10 million. So I'm going to be using the name for 10 years, and I'm going to pay $10 million. That is a franchise. That is a franchise. Now, in my books, what am I going to do? Double entry. What do I do? I'm going to be debiting intangible assets, and I'll declare in the footnote that this is a franchise with a $10 million. Then I'll credit cash if I actually wired the entire $10 million to them. Or better still, I tell them I'll pay the money maybe every year. So I credit payables with the $10 million. So that is the initial recognition. Now, because it is for 10 years, every year, what I need to do is to what? Amortize it. Amortize it. So the amortization will be the annual charge. So my amortization will be the cost of the franchise, $10 million, divided by the economic useful life, 10 years. And that gives me $1 million. So every year, I'm going to be amortizing or spreading $1 million over the economic useful life of the franchise. So what will be the double entry for that? I'll debit the P&L account with the $1 million, and then I'll credit the franchise account or the intangible asset account $1 million. So that is how we deal with some of these issues. So it depends on the question at hand. It depends on the scenario that we're looking at. But if the asset has a definite economic useful life, then we amortize it. But if it has no definite economic useful life, then certainly there is no way it can be amortized. Instead, what we do is to test for impairment. What we do is to test for impairment. So any questions? That is all about IAS 38 intangible assets. I'm going to be coming back to this in a moment, but impairment has brought itself up, so we need to talk about him. Like I mentioned earlier, you realize that impairment has brought itself up, so we're going to pick it up and then expand on it. So let's move on to IAS 36 intangible assets. Sorry, IAS 36 impairment of assets. You ready? Let's go. Impairment of assets. IAS 36. Right, so I see a comments coming in from Lukman, Jace Jackman or so. Says, good day, Nhyira. Good day, Lukman. Hope that you're doing well. Welcome to the stream. I see some of you guys joining. Smash the like button when you join the stream as we move ahead with our discussion in the IFRS Masterclass. And also remember to share the channel with others so we can reach as many students as possible. Francisca Boache, I see you. Good evening. I hope you're doing well, Francisca. Welcome to the stream. Welcome to the stream as well. So let's go into the discussion and let's look at how we deal with the issue of impairment of assets, IAS 36. Now, the objective of IAS 36 is simply to ensure that assets that are carried, or to ensure that assets are not carried more than their recoverable amount, is to ensure that assets are not carried more than their recoverable amount. Okay, I see a question coming in. Lukman said, Nhyira, can we know the done deal standards? Yes, I've already covered this on the channel, the done deal standards. You can watch how to pass accounting standards. You can check the accounting standards playlist on the channel and you'll be able to watch that. I think we've already covered that on the channel, but I made mention of the done deal standards. And also, if you are in our paid program, if you are doing financial reporting, the paid program of our financial reporting, or you are in corporate, you have enrolled in our corporate reporting, I've also shared this where we looked at it more deeply in our paid program, where I spoke about all the standards. Like you can see here, this IFRS Masterclass, and this is for our on-campus students, our online students who are paid students in that case. And we spoke about all the standards, the categorization of all the standards, and everything that you need to understand about all the standards. So the done deal standard, I've covered that already on the channel. So you can check it out, how to pass accounting standard, I guess, how to pass accounting standard. It's in the accounting standard series playlist. You can check it up in the playlist. Okay, it's even in the description to this video. It's in the description to this video. When you check the description to this video, you will see the part 1, how to study accounting standards. So you can watch that video in the description of this very video you are watching. When you go to the description, there are some links there. You will see, watch the entire series here, part 1, how to study accounting standards. In that video, I broke down every standard that you need to understand and the various things that you have to focus on. So Lukman, you can check that out on the channel. Franklin Deck said, good day, sir. We would like something on IAS based on liability and performance. I don't understand your statement, Franklin. Can you clarify that for me so I can answer you much better? Can you clarify that so I can answer you much better? Are you talking about IAS 37, provisions, contingent liabilities, contingent assets? Is that what you're talking about? Then Kiana said, good evening, sir. Good evening, Kiana. I hope that you're doing well. Welcome to the live stream. Lukman said, okay, thank you very much. You are really a blessing. Always a pleasure. Always a pleasure. So let's go into it. If there are any questions you have, you know what to do. Put it in the chat box. I'm going to be replying to all of your comments. in that case. Now, IAS 36, impairment of assets, intangible impairment of assets. Okay, so Franklin is saying IAS 37. Okay, so I'm going to be adding that to our question slide so that we'll be able to look at it. Let me just add that real quick here. Probably that will be the next standard we will cover on the live stream. Who knows? Yeah. Because everything we are doing, it's based on what you guys want us to cover. But like I say all the time, you need to really get a grip of all of the things you need to pass the exams. And one way to do that, or the only way to do that, is to enroll in our full course online. 390 Ghana cedis per paper. You get access to everything you need in order for you to really pass the exams. So provisions. Okay, so I've added that to my question log here. Okay, so let's go back. Leonard said, it's possible that you can combine it with IAS 37. I don't understand the statement. Which one are you saying? Is it it's possible that I can combine it with IAS 37? So you can clarify that for me real quick. Right, so as I wait on their reply, let's go in. So what is the objective of IAS 36, intangible assets? What's the objective of IAS 36, intangible assets? In a simple language, the objective of IAS 36, intangible, I'm still talking about intangible assets, forgive me, all right? Impairment of assets. So the objective of IAS 36, impairment of assets, is to ensure that assets are carried at no more than their recoverable amount, and to define how recoverable amount is determined. So two things. The objective of this standard is to ensure that assets are not carried more than their recoverable amount, That's the first thing. And number two, to define how recoverable amounts is determined. So two things off the bed. We want to find out, because you see, assets cannot be carried over their recoverable amounts. I made this statement when we were talking about IAS 16. And I told you that when we get to impairment, we're going to be really taking that to another level and making sure that we really understand what is going on there. So two things that we need to know in that case. Okay, so Leonard is saying that I meant that is it possible for you to combine IAS 36, 37, and 38? For the purpose of the way I present I want to present this, I'm combining the 36 and 38 as we are doing. The 37 will be covered later on, definitely on the channel. So you stay connected and we'll be able to cover that later. So that is the objective of the standard. But not only to make sure that assets are not carried more than their recoverable amounts, but also to determine how the recoverable amounts can be calculated. Now, the key question then we ask ourselves is, what then is the scope of the standard? What is the scope of IAS 36, impairment of assets? Now, IAS 36 applies to all assets with the exception of the following. IAS 36 applies to all assets with the exception of the following. 1, inventories. Inventory is an asset, but the treatment of inventories is in accordance with IAS 2 inventory. So, yes, there will be fall in value of inventories. Inventory should be carried at lower of cost or net realizable value, but IAS 36 doesn't come to town there because there is a standard designated for the treatment of inventory. Next, assets arising from construction assets or assets arising from construction contracts. Assets arising from construction contract also, we can account for it in accordance with IFRS 5. Revenue from contracts with customers. Revenue from contract with customers. So again, that contract asset we're going to be having, if the contract asset value is falling, you don't come and talk about IAS 36, but you're going to talk about what? IFRS 15 is IFRS 15, sorry. IFRS 15, revenue from contract with customers. Next one, deferred tax assets. There could be reduction in the value of deferred tax assets, but also this has been enshrined literally in IAS 12 income tax, and we'll look at that later on as well as we go through. Next one is financial assets. Financial assets. If you're a good student, financial assets is in accordance with IAS 39 or IFRS 9. So the way we treat financial assets, that when there is a reduction in the value of financial assets, you don't just call it impairment and say we should account for it in accordance with IAS 36, but we account for it in accordance with what? IAS 39, financial instrument recognition. Next one, investment property. Investment property carried at fair value. Investment property carried at fair value. If you're a good student, we've done IAS 40 already. When an entity is having an investment property, there is a standard that governs how investment property should be accounted for. And I mentioned that already, IAS what? 40. So IAS 40 has prescribed the treatment of investment properties. So when there's a reduction in the investment property, we don't say, let's come and account for it in accordance with IAS 40. That is not done. Then agricultural assets. Agricultural assets. Now, when it comes to agricultural assets also, these assets carried at fair value. These assets also, there is a standard that governs how we account for it, and that is IAS 41. Another standard that you need to know about. So agricultural assets that are carried at fair value, that also has a standard that governs it. So if there's any reduction in the value, you don't say, oh, it is impairment, so let's account for it in accordance with IAS 36. No, you got to account for it in accordance with IAS 41, agriculture. Franklin Deck is saying, what is deferred tax assets? Deferred tax assets comes in when your temporary difference is negative, or it's usually when the carrying amount of an asset is less than the tax base of an asset. And I will explain this much better when we are doing IAS 12 later on. But there is a video already on that on the channel that you can watch. But that is a deeper subject that we will look at later on, or a deeper topic we will look at later on. Then insurance contract assets. Insurance contract assets. For insurance contract also, there is a standard, IFRS 4, that governs how it should be accounted for. So if there is a fall in value, you don't say it's an impairment, hence we should account for it in accordance with IAS 36. No, we're going to account for it in accordance with IFRS 4. Then the last one I want to share with you is the non-current assets held for sale. Non-current assets held for sale. Now, when it comes to non-current asset held for sale also, if you're a good student of this standard, it is IFRS 5. Non-current asset held for sale. That is IFRS 5. So there's a standard that governs how non-current asset held for sale are to be accounted for. So you've got to understand or measure how it should be accounted for. Yes, after we recognize an asset as a held for sale, it has to now be accounted for in accordance with what? IFRS 5 and IAS 2 inventories, because we will carry out the lower of cost or net realizable value. So what are we saying here? IAS 36 applies to all assets. With the exception of the following: inventories, assets arising from construction contracts, deferred tax assets, financial assets, investment property carried at fair value, agricultural assets carried at fair value, insurance contract assets, and non-current assets held for sale. Non-current assets held for sale. So these are the things you have to understand about what we need to look at in that case. Then, if these are things that IAS 36 doesn't cover, then what assets does it apply to? So IAS 36 applies to the following standards. Applies to the following assets. IAS 36 applies to the following assets. 1, land. 2, building. 3, machinery and equipment. 4, investment property carry at cost. 5, investment property carried at cost. 5, intangible assets. 6, goodwill. 7, in associates, subsidiaries, and joint ventures. And other intangible assets carried under IAS 38. And other intangible assets carried under IAS 38. Now, you want to pay attention to what is going on here. You realize that you are seeing investment property here, but it is investment property carried at what? Cost. Because if the investment property is carried at fair value, then we will account for it in accordance with IAS what? 40. It's very, very important for you to understand what we need to look out for in here. Now, I see some comments coming in. Let me look at them. Chukudi said, please, is LIFO method still permitted in stock valuation? It depends on, it's a method that is available that entities used, but it depends on what we are looking at. Because the tax authorities will prefer the first in, first out to help accurate valuation of inventories in that case. So it depends on where you are standing at, but it's still a method of stock valuation that is useful by organizations. Benedict Amankwa said, I think you can calculate impairment on IFRS 5. When you say you can calculate, what are some of the assets that you are mandated to calculate impairment on? It is not about what you are mandated to do, it's about what a standard is covering. So what is the standard covering? The standard is covering land, building, machinery, investment properties at cost, intangible assets, goodwill, investment in associates, subsidiaries, and joint ventures. These are what IAS 36 covers. But other assets that are recognized under other standards, IAS 36 does not cover it. I understand your point saying that we can, you think we can calculate impairment on IFRS 5. No, we don't say impairment. We don't calculate impairment because after the asset has been recognized as a held for sale, on subsequent measurement, it will be carried at lower of cost or net realizable value. So even though you will use the word impairment, you are not accounting for it in accordance with IAS 36. That is what we are talking about here. So it is about what the standard is covering and not what we can compute in that case. So that is something that you need to clarify in there for that. Jeremy is saying, when is the FR class starting today? Yeah, our FR class will be starting at 6, maybe 6:10 or so, something like that. So we will be, you are in the group, so the meeting detail will be posted and you'll be able to get the details to join the class, all right? So you'll be able to get the details to join the class. So these are what you need to understand about what IAS 36 covers and what it does not cover. What IAS 36 covers and what it does not cover. So that is the concept about what you need to understand when it comes to dealing with the scope and what it covers in there. Now, the next thing we want to look at is some key definitions. Some key definitions. Any questions, please put it in the chat for me. Any questions, please put it in the chat for me. Lockman Jackman said, Nhyira, the ICAG study text does not have IAS 39. That is actually financial instrument. Once you know about IFRS 9, you are good. Because when it depends on whoever is teaching you, but anybody teaching you financial instruments will actually cover everything under IFRS 9 that IAS 38, that IAS 39 should cover. So IFRS 9, once you understand that, it covers everything in there. Because personally, when I'm teaching this, I don't really segregate all the three, because there are 3 standards on financial instruments, like 3 standards on financial instruments. We have the disclosure, we have the presentation and recognition, and then we have the measurement and those things. So I think there is IFRS 9, there is IFRS 7, and there is IAS 39 in there. So it depends on where you are looking at or what you're looking at. So what are the things we want to define? What is impairment? 2, what is a cash generating unit? CGU. Next, what is carrying amounts? And then, what is recoverable amounts? So these are key terminologies that we're going to be using, and we want to make sure that we know their definitions offhand. What is impairment? What is a cash generating unit? What is carrying amounts? And what is recoverable amounts? So for time constraint, I'm going to be concluding around here today, and God willing, Monday, we're going to be coming back and then finish with this and then answer or solve some questions in that case. So I'm going to be concluding around here today. If there are any questions, put it in the chat box for me. In case you missed the series, you can check the description to this video. You're going to be getting all of the content there. Or you can also check on the channel. There is a playlist there. You go under playlist. There is a playlist titled Accounting Standard Series. And I've covered a lot of the standards in the past that you can get in order for you to prepare well for the examination. Now, in case you want to go the extra mile and really get access to all the contents, the question kits, join our weekly live Zoom sessions and study directly under my mentorship, have me and ask me questions on the spot and anytime, then you can enroll in the full course on our study portal, NhyiraPremium.com, and it's $390 Ghana cedis or $68, and you can enroll, get access to the full course, and let me assist you in order for you to prepare well for your examination and most importantly, pass the exams. So thank you very much for joining us throughout the week. It's been a great week, week 4. We are now in week 4 in our discussion for the ICA May 2021 examination. I'm very much excited about this week because we have been able to cover some things in the fundamentals in management accounting, then also some issues in relation to the accounting standards, focusing on IAS 36 and then IAS 38. So God willing, next week, we're going to be continuing with the discussion and seeing how we can go through in that regard. Please note that there are a lot of things that we could cover on the channel, but we are limited because of time, and we are limited because we cannot just release a lot of content on the channel like that. It hurts the channel and will not be able to really help the video to reach anywhere. So in case you are looking for full content, you want to get access to everything, then you can enroll in our full course on our study portal, NhyiraPremium.com. The link is in the description and also pinned to the live chat. You can click on it at $390 Ghana cedis. Enroll, study directly under my mentorship, get access to our ebooks, question kits, join our weekly live Zoom sessions, and learn directly under my mentorship. And let me assist you in order for you to prepare well for your examination. So thank you very much for joining me this week. I'll see you same time on Monday, 4:30 p.m. GMT, and throughout next week, hopefully, God willing, as we continue with our discussion. Montadi said, enjoy your weekend, sir. Thank you very much. Enjoy yours too. And make sure that you continue to study. Like I tell you all the time, don't sit down and wait for 2 weeks to the exams and take a leave and be serious. Or 1 week to the exam and start being serious. You're going to buy yourself some emotional trauma, emotional pain that will not go away. So what you want to do is be consistent, be dedicated, gradually do something small every week, do something small every day. It is possible to do it. Even if it is a 1 hour that you can do it. Because I believe that if you do it gradually like that, it helps you so that during the revision session, you are able to now have an understanding and put the pieces together so you can position yourself to pass the examination. So that is what you got to understand. And thank you very much for joining the stream. It's always a pleasure coming your way. And I take it really a privilege that I'm able to assist you, hold your hands in order for you to become more successful. So Leonard, Jeremy, Roland, Penny Perry, Lukman, Francisca, Kiana, Franklin, Chukudi, and everybody, thank you very much for joining the stream. I'll see you same time next week as we continue with our discussion. Till we meet again, stay safe, stay blessed, and enjoy your weekend. Bye-bye.